All right. Hello, everyone. My name is Patrick Chu. I'm the Policy Initiatives Lead here at the Association of Registered Nurses of BC, and I'd like to welcome you to our webinar on mortgage options. ARNBC recognizes that among many perks of a professional association includes having access to programs and services that support members outside of the professional lives. And like all webinars, ideas come from nurses themselves across the province, and we're really happy to have Alan here today to discuss the topic of mortgages, which has been requested by some members. So Alan has been a mortgage consultant since 2002 and has offered countless homebuyer seminars and has extensive experience in offering information to educate people in the entire home buying process from the initial purchase to the possession date. Since 2002, Alan has been a member of the Verico Complete Mortgage Services, Seniors Mortgage Professional, Mortgage Professional Canada, Canadian Mortgage Brokers Association, and Mortgage Broker Association of BC. Alan received his accredited mortgage professional designation in 2008. So please note that you are all currently on mute. If you do have a question, you can type it into the taskbar that's located on your right-hand side. And we'll have Alan address them at the end. And as you can see, Alan also has two handouts that you have access to at that same taskbar on your right-hand side. So the presentation will be about 40 minutes, and we'll leave the remaining time to answer any questions that come up. So I'll pass it over to Alan.
Hi, my name is Alan Seltzer, and thank you very much for that introduction. I appreciate the Association of Registered Nurses of BC allowing me to speak today on about mortgages, my favorite subject. So first of all, I'll tell you a little bit about what we're going to go over, and as Patrick mentioned, please feel free to ask your questions. There's no wrong questions. They're all appreciated, and it's as important as to what I have to tell you is what you would like to know out of this webinar. So first, we're going to go through the basics of a mortgage, what lenders are looking for in you, and of course, the entire mortgage process. So first of all, what is a mortgage? The root of the word is mort, and the other word is gage. Mort is the French word for death, and gage is the Latin word for grip. So that's my best joke of the webinar. Thank you, Patrick. First of all, a mortgage is a long-term loan to purchase a home. If you had a car loan for $500, $600, $700 for $20,000, $30,000, $40,000, imagine what that would be for $200,000, $300,000, $400,000. It would be completely unmanageable. So this is a way of extending the payback time from, let's say, for example, an auto loan is usually 3 to 7 years, extending it to 25, 30, or even 35 years so that the monthly payments are achievable for most people. It's the largest single magnitude of debt or oftentimes investments of people's lives. So it's a very good idea to take care of your debt as well as you take care of, or as carefully as you take care of your investments, which people look at very closely, and their debt they tend to not look at so closely because it's not as sexy as investments. So everybody could use professional guidance, and that's what I do. So can you get a mortgage? First of all, it depends on what I call the 3 pillars of lending. First one is down payment, what you have, your skin in the game for this purchase. Your credit history is, we'll talk about your credit bureau in detail. Your credit bureau is your last 6 to 7 years of information of how you've paid back all of your credit cards, and now they're looking to give you a lot more money, so they're looking at your past history very closely, especially the last 3 years. And your income, your ability to pay back the mortgage. So first, let's look at the down payment. Down payment is money that is typically in your account for 90 days or more. That's probably the simplest way to think about a down payment. There's other sources. One of them is a gift from an immediate family member, and we'll talk about some more at the next slide, which is one of them is the new BC government 5% or up to 5% match. So let's get an example, or let's give an example of a house cost is $400,000. Your minimum down payment would be 5%. Now, important to realize is that 6 or 8 months ago, the Bank of Canada decided that they wanted to have anything over $500,000 purchase to need a 10% down payment for that part of the down payment. So in other words, let's take, we have in a $400,000 mortgage, you need a minimum of $20,000. But let's take an example of $600,000. In a $600,000 mortgage, 5% would be $30,000. Today, the amount over the $500,000, so we're talking about $100,000, needs to be at 10%. So instead of being the $30,000 that it was, say, 8 months ago, now it's $35,000. And we can take that through anything up to $1 million. And that's the minimum down payment for a mortgage and for a CMHC approved Canadian mortgage that we can get that's insured with the lowest down payment. So now I mentioned before, the source of a down payment is very important. As I mentioned, it's one of the 3 pillars of lending. The importance of this is that the lenders have only those 3 pillars to go on. So the first thing they want to do is they want to see, if possible, the savings of the amount of money that you are going to put down as your down payment in a bank for 90 days or more. Now, does that prove anything? Kind of, sort of, not really. In fact, it's difficult to show this money available for more than 90 days. If you've gone and borrowed it from a neighbor, it's not likely that they'll want to lend it to you for a long period of time. 3 months is quite a long period of time. If it's money coming from money laundering sources, illegal sources, they're certainly not going to want to give you the money for a very long period of time. So we have to show that it's something in your account, and it takes maybe 80% of the possible frauds into account. And if we show it in your bank account, then that's great. Now, another form of down payment is an immediate family gift. So a mother, a father, a son, child, or a child can gift you that money, and there's a specific form that we have that will state and will be signed by both you and the giftor that this is money to be is a gift and not to be repaid. And then we have to see the confirmation of that money going into your account. Now, a tax refund. Any money that you get back from the government is money that you've paid over the entire year on your income and is now coming back to you. So that is also an allowable source of down payment. Now, the sale of a property or an asset, that's not a problem. We just need a confirmation of that sale that has happened, an offer of purchase and sale that's actually that has no subjects on it is a fine confirmation of down payment. Or the sale of a motorcycle. People have assets like motorcycles that are sold, and we have a confirmation of that sale. That's money that you now can use for down payment. Now, we're going to talk a little bit more about the RRSP, the Home Buyers Plan. Also, we're going to talk, I say no borrowed money, but in fact, the BC government is loaning up to 7%, and that can be used. Most lenders are now on side with that, and more are coming on all the time, and we'll talk more about that in a moment. So first of all, the down payment can be from an RRSP. Now, there's a couple of things that you have to know. First of all, there's a bunch of rules, and I'm going to give you the best thing is to look up the CRA website, because there's quite a few more rules that I'm going to talk about here because it's fairly complex. But in general, $25,000 per partner is the maximum. It has to be paid back in 15 years. So I believe they give you 1 year grace, and then every year after that, you have to pay back 1/15 of what you borrowed. So let's take a very simple example where you borrowed $15,000. $1,000 is paid back each year to your own RRSP. So that's in the way that you won't have any income tax issues. If you recall, when you give an RRSP or when you invest in an RRSP, you take that money off of your income, and that's one source that you would get money back at the end of the year for your taxes. Well, now, if you take out money of your RRSP, normally it would be taxed as if it's an increase in your income, which of course in this case it's not if you pay it back in this way. If ever there was a year in the next 15 years that you don't pay it back, it is added to your income. Now, the funds that you take out of your RSP must be in your RSP for at least 90 days before being removed. And there's a bunch of other pieces of information about it that are on the CRA website, or we can talk about it another time. So now your down payment. There is insurance for anybody with a down payment of less than 20%. So keep in mind, CMHC is an insurance that's added to your mortgage. It's not like the down payment that you have to come from your own sources or a gift or whatever. This is something that's actually added to your mortgage. So take a very simple case. Your mortgage is $100,000. You have a 5% down payment, $3,600, which is 3.6% of your mortgage is going to be added back to your mortgage. So you're going to have $103,600 as a mortgage. So your interesting cost for $100,000. Okay, this has been there is something new. That is the 5, 10, and 15% is now, if you've taken advantage of the BC, the new home purchase 5% matching loan, the insurance premium on a 5% down payment is now 3.85%, and on a 10% it's 3.6%, and on the 15% is still 1.8%. So on a 20%, anything over 20% is always a zero insurance premium. So you're not paying anything for insurance if you have a 20% down payment or more. Okay, so the next thing I want to talk about, it's gotten missed on this version of the presentation, but I wanted to bring up the 5% loan that we're able to use as part of your down payment. Now, I guess the way that it was brought up is that somebody who has trouble coming up with the 5%, but easily has good credit and is able to qualify income-wise, can get a help with their down payment of up to 5%, simply matching the funds that they're bringing in. So let's say you only have 3% of a down payment. The other amount that you're able to get up to 3% from the BC government as a loan, and that amount is capped at the $750,000 purchase price, which is $33,700. So that's something that you're able to take advantage of. We have to qualify it at with all of your income. We qualify that. We use that down payment as part of your down payment. We use that loan, or the BC loan, matching loan, as part of your down payment. Okay, so the next thing. All right, we just have a bit of an older version here. But anyway, the credit history is very important. It's the second pillar of information of your for your application. And what the credit history does, it gives you the last 6 years of detailed credit information, which is your credit cards. It gives us all of the information of your lines of credit that you've taken out of any lender, as well as most of the auto lease payments. At this point, it doesn't matter. We'll move beyond it anyway. Now, I have a great story of a very good friend of mine who had me over to at his business to do a lunch and learn. And part of the presentation was, as you can see, credit history. And I went through the next things that I'm going to go through with him and his staff. And about 3 or 4 years later, he calls me up and he says, Alan, I need to get a mortgage. And I said, oh my goodness. I said to myself, this is going to be trouble, because he had gone through some very, very bad times with his business, and I didn't know how his credit was going to look like. So it came in, and his credit was immaculate. It was absolutely perfect. And before, we had talked about all of the burden and the amount of debt that he racked up, and I was just so worried, and it was perfect. So I said to him, how in the world did you keep your credit so immaculate? And he says, well, you were at my office several years ago, and you explained how to take care of my credit, And that's what I did. So here's what I told them, and I think it's great advice. First of all, it sounds easy, but pay your all of your debts on time. If you have a date that is, let's say, the 3rd of January, pay at least the minimum on that date. And there's really nothing, if you do that, your credit will be excellent on the terms of when you're paying on time. And what will happen is you actually have an extra 30 days, which people don't know, but you actually have 30 extra days after that in order for your credit not to be affected. But on the other hand, you have to be careful because if you can and you pay your everything on time, you have to pay the full amount on time, so you don't pay interest. But that is another level of excellent credit. To keep your credit, the best is to pay it all on time and in 100%. The next thing is to keep your balances below your limits. Keep the balances below 60% of your high limit, and that will also be something that people don't normally know about, but it's important that if your credit ever gets towards your limit, that's a big red flag for the credit bureau. The other thing is don't let too many people check your credit. With a mortgage broker like myself, I can usually get away with doing your credit only once. And if you're going to go to many people, you're going to see they're going to do your credit every time. Anybody who asks you for your date of birth, your social insurance number, and of course your name is going to be doing your credit bureau. So don't give that information away until you know that that's what they're doing and that's what you want them to do. And normally there is something I have to get in writing to get your permission to do that. Some of these credit cards that come to your door automatically, they actually ask you to sign if you want to accept their terms, and then they'll do your credit bureau. You're actually signing to give them consent. So don't sign too many of those. The more credit that you have, the score is hurt a little bit each time. So I told you about the success story at the beginning. Here's the way that you can check your credit if you want to. I can tell you that if you followed all of these pieces of advice, never wavered from them, your credit's going to be excellent. You don't need to do anything. If you've ever had a credit scare, if you've ever had credit fraud, there's lots of things you can do to check, and one of them is call 1-800-465-7166. You need to have your credit cards and your account statements nearby, because they're going to ask you a whole bunch of information about how to figure out that you are who you are. The next thing is there's a website, but the website costs you about $20. There's no reason to pay the $20 unless you're in a big rush. Equifax will, in fact, mail you the information. My other favorite story of credit history was a fellow who came to my office trying to be the co-signer or help his son to get a mortgage, and we found out that this fellow had he had bought a mattress at a mattress store, and he got into a situation where he thought it was no payments, no interest. It was actually only no interest. He still had to make payments for a year. After 3 months, they got after him that his payments were in arrears. They'd actually sent it to a credit bureau, which is really bad on your credit bureau. And the lender wasn't ready to give him a mortgage based on this, or have him help give his son a mortgage because his credit was damaged because of this. And this is the only time ever that I've been able to get a credit credit history like that erased, because the fellow, in fact, when he found out that he was in this kind of situation, not in a no payment and no interest, he paid it all off in 3 months. So the credit company was able to reverse everything. Very unusual. Now, qualifying income, the third pillar of lending. First of all, is it's easiest with permanent and full-time employment. So that's one thing that lenders are very happy about. It's considered to be the most stable income. The next income that I think we see quite often with nurses is a casual type of work. There's very few exceptions, but with the 2-year average, no problem. As long as there's something either part-time or casual, and we have a 2-year average of income, everything is fine. The next thing is investments. If you have investment income, let's say you're retired, or let's say you're just starting to work, but you you have a sizable investment fund and you're able to show that you paid taxes on that money or that income over the last 2 years, we can also use that. The next thing, even if it's just started, is pension income is fine, as long as we can confirm that it is ongoing, and so that's perfectly allowable income. Now, the next thing is, we can show you, this is probably the most important thing, and one of the things that I do in detail when I talk to my clients, is how much money you need to get a certain amount of mortgage money. So the rule of thumb is about every $20,000, you can get about $100,000 of mortgage, and your monthly payments are under $500. So this graph is on a rate that's a little bit lower than we can get today, but it's pretty close to what you can expect. For every $20,000, you get $100,000, and you pay just under $500. So on an $800,000 mortgage, $80,000 as income, your mortgage would be about $400,000 that you could be qualified for, and your payments would be under $1,900. And now, when we have down payments that are lower than 20%, the 25-year amortization is the longest. As I mentioned earlier, if we have, we can get 30 and 35-year amortizing mortgages, but today they're just a little bit more expensive, and not all lenders are able to do them. Okay, so the different types of mortgage products that we're able to get for you. The first one is fixed rate products. Those are the ones where we are the most stable. The 5-year fix is where we are allowed to get the most amount of mortgage for you. So if we're looking for an amount to maximize the amount of money we can get, then fixed rate 5 years, which today is around 2.84, and some a little lower, it could be as low as 2.79. They're in that range. Variable rate products are you can get the least amount of mortgage for your income, but sometimes that's not an issue. If there's plenty of income, which can happen, then we can use a variable rate product, but their rates are not that much lower than the rates of the fixed rate products, and so the reward for taking the risk of rates potentially going up in the next 5 years may not be great enough to actually make that decision of variable rate mortgages. They were quite popular, I don't know, 6 months to 18 months ago when things were quite low, and we thought that that would stay for a very long time. Today, we're thinking with what's going on in the States, so we might see some inflation, some high spending in the States, and we might see rates increase. So the variable rate is not that attractive at this point. We have what's called home equity lines of credit. A home equity line of credit is attached to your home, so it's usually put on your home at the same time as a mortgage or as part of a mortgage. There's many lenders that have a line of credit that can become part of a mortgage, but then we have a maximum of, a minimum of 20% or more down payment in order to get a line of credit or a home equity line of credit. Reverse mortgages are interesting. We have, you've probably read in the newspapers, people complaining their taxes are very high. They own this several $million-dollar property, but their taxes or their, some expense is killing them that's involved in a property of that high a value. Reverse mortgages, if the client is the right client for them, are excellent to take away that stress. They, in fact, give the client money, and the interest is added to the mortgage amount on a regular basis through the rest of their lives. So, for instance, somebody who's retired or somebody who's potentially inherited a home that they want to live in but they can't afford, this is a great way to do it. Ideally, if we have a regular mortgage, everybody ends up with more at the end because the reverse mortgage basically eats away at the equity in your home or the amount of the home that you actually own. So instead of paying a mortgage and reducing it in size over the years, this one actually increases the size of the mortgage. The big advantage is that there's no payments. So if the payments are, let's say if there's a parent in your life and their payments for their mortgage or even just their taxes are killing them, this is an alternative. Now, there's other products, private products and alternate products. They are more for people with credit issues or have had credit issues in the past. And this is one way of getting through it. I have client right now who 3 years ago, we went into a mortgage that was about 1% higher than the competitive mortgages. Today, 3 years later, we're going at a mortgage that is best rate. So they spent 3 years. We were able to incorporate all of their credit card debt into the mortgage, pay it all out, and now they have excellent credit and their incomes are improved, and we're able to get them a best rate mortgage. So I have there is a handout, and that is of closing costs, but I just wanted to go over them quickly. Property transfer tax is probably one of the biggest, usually one of the biggest closing costs. You will not pay any property transfer tax if you're paying less than $475,000 to $500,000. If you are paying between $475,000 and $500,000, you'll be charged a prorated amount. So if you're halfway between $475,000 and $500,000, you'll be paying half of the property transfer tax. Property transfer tax under that, up to, the first $200,000 is at 1%, and the balance is 2%. And that's up to $2 million purchase. Anything over a $2 million purchase is still 1% on the first $200,000 and 3% on the balance. So that's something to keep in mind. Legal fees are usually $1,200 to $1,500. Appraisal fees usually about between $300 and $400, and title insurance is usually about $300. So the way that this is done, the way that the process goes, the first part is pre-approval. So even before you go out and look for a home, it's nice to know how much you can afford. So we would have a discussion about what are your options. I would find out your income and your down payment and look at your credit history, which is something usually a branch bank won't do because it costs money. We'll look at your mortgage options, and we'll have a pre-approval for you within 1 to 2 days. The nice thing about doing this is right after that you can get qualified for the BC government 5% loan. That's the first step and the first application to the government. You'll go online and they'll ask you a series of questions to qualify you, and then we go through the steps together as you find a property to buy. Accepted offer, I will work with the bank that you're dealing with to send the documents that I will have asked you for, which I actually put in as the other handout, and we'll get everything accepted by the lender. We don't let you have a complete subject-free offer until we're completely satisfied that the lender will go forward. So when you make an offer, you make an offer subject to financing, and usually have about a week to take that off. And we work hard to make sure that we never have anybody in any risk. Thanks. Okay, so the process is as follows. We go through the pre-approval with a full review as you start shopping for a new home, and that's the first one we just talked about. Pre-approval is the first step. The next thing we're going to do is review the income, your income and your property once you have the accepted offer. Now, an accepted offer is usually subject to perhaps you want to have an inspection, but certainly unless there's very, very few situations that I would allow that you go in subject without subject to financing. Normally we need to, because the lender doesn't know your property and certainly has to double check everything about you. The pre-approval stage, they won't make a phone call to your employer. They won't be able to do those things. It's too time consuming. They'll do it once you have an accepted offer. And then the next step is we get the financing subject to be removed, but only after everything is 100%. The next thing I do, which I really enjoy, is I call your lawyer or notary, and I make what I call a ducks in a row call. So 1 week before closing, I'll make a phone call and ask for the 2 documents that are the most important to you, which are a statement of adjustments, which tells you exactly why you're coming with how much money to the lawyer to sign, and the land title form B, which is the actual mortgage document that gets registered at the land title office. I remember I once had a phone call with a lawyer and notary. The person said to me, "Why are you calling?" And I said, "Well, I'm a mortgage broker and I want to make sure that my client is taken care of, and this is a way of me making sure that the lender has given you the right information." And they said, "Oh, we have everything, we don't need you." And I said, "Okay, no problem, that's okay." And somebody came in to the call and said, "Hey, excuse me, are you so-and-so's mortgage broker?" And I said, "Yes, I am." So the person said, "You know what, we don't have the instructions, can you help us?" And when I make this call a week before, it's easy. When it's the day of, it's impossible. So that's why I make sure that everything is done. Most lawyers and notaries are surprised by this phone call because they're not involved with the mortgage broker at the end, but I make sure that everything is 100%. And that's the presentation. My name's Alan Seltzer, and I'm an accredited mortgage professional with Verico Complete Mortgage Services. And if there's any questions, I'd be happy to answer them.
And this is just a reminder for those people who joined us late. If you want to ask a question, please type it into the taskbar on your right-hand side. So we do have a question. From, let's see. What would you recommend as an ideal down payment?
Okay, that's a great question. An ideal perfect world down payment is 20% or more. Now, that's not the reality for a lot of people, and that's why the insurance companies like CMHC, Canada Guarantee, and Genworth are there. There's 3 competitors that are looking for your business, and it's invisible to you, but they're there to allow you to go with a minimum of 5% down payment. So I guess the question is, the minimum cost for down payment is if you have 20% or more. The more you have, the more that the less cost there is. So if you're talking about the source of the down payment, savings in place for 90 days is ideal, but there's many others that we've talked about. Credit history in the last 6 years is, okay, so someone's asking, you mentioned credit history within the last 6 years. Does this mean anything out of 6 years is not included? Okay, the answer to that is yes and no. Anything that you've perhaps, let's say you have a bad payment, let's say 2 or 3 payments were bad 6.5 years ago, they've disappeared. A bankruptcy will not necessarily disappear. Collection will not necessarily disappear, but most of the credit history will disappear 6 years after it's cleared up. So let's say you have a payment that you're still not making and still not satisfied to the retailer, it's still on your credit bureau. So I guess there's a yes and a no answer. And what is okay, the benefit of a home equity line of credit is as follows. You now have an account. Instead of being an account that you put money in and you take out, this is an account that's available borrowing that you can take and put back. So it's like a bank account, but in reverse. You borrow from it, you pay it back anytime you want. There's no penalties, there's no minimum return of the money, and there's no cost to having a zero balance in a line of credit. Okay, there's another question, credit card fraud. Okay, I give you all my empathy for having credit card issues. Fraud is awful. If it's ongoing, it's very difficult. If we get some kind of a confirmation that it is fraud and it's being dealt with from the lender side, then it can be ignored. If it's there and it's so raw that it hasn't had any settlement yet, then it's a problem. But I've had situations where clients have had a letter from the retailer, from the Visa card, that this is being dealt with and it's not the responsibility of the borrower. then that's no problem. And that's about it.
Yeah. Any other questions for Alan? Feel free to type it in. We'll give you a few more minutes.
Okay. Alex has another question. One thing that I can tell you, it's today rates have become an incredibly complicated subject. So if there's anything rates-wise, we have a variety of different rates depending on your down payment, depending on the amortization you want. And the question is, you mentioned not to let too many checks be done against your credit. What is too many? Okay, it is normal from time to time. If I see 2, 3, 4 in a year, it's fine. You might have been getting perhaps a car lease. You might have taken on a credit card. After that, and when it starts to look like it's a repetitive habit, I guess, and there's too many things that are coming up and too many credit cards that have been accepted, then it's a problem. As you have a credit score which is somewhere between about 630 and above, you can get any mortgage. 630 and above, you can get a mortgage. 680 and above, you can get any mortgage. If you pay your bills on time and you follow the rules that the recommendations that I gave you earlier, you will be 100%. You'll be well over 700. If for some reason you've got some credit cards or lines of credit that are very close to the maximum, then you'll be in the high 600s if you follow everything else. As long as, there's a whole bunch of things that add on to the improvement or the deduction in your credit score. You want to make sure that you minimize the things that do you harm and you maximize the things that are going to help you, which is paying back your credit cards at least the minimum on time, or it's complete paying back on time. So too many would probably be, it's unusual to see more than 2 or 3 credit checks in a year for a client. There's not too many things that you would need to do in 1 year that would cause you to do more than that. Thank you very much for all of your questions. Oh, here's another one. Okay, very good question. How long does it take to improve a marginal credit score? It all depends on what the issues are. If, in fact, you found out, and I have clients who said, why can't I use my $10,000 credit limit on my Visa card? They have ramped it up to $10,000 and down and up and down, and that's a problem for their score. So once you pay it down and you keep it low, especially if there's several cards that are up at near the maximum, your credit score will improve immediately. If it's behavior where, let's say, bad repayment terms have had to go into history, it's usually 3 years or more until things will dramatically increase. But every year it gets a little bit better. Okay. Excuse me. So if that's it, I really thank you so much for your time. And, oh, hang on. Oh, thank you. Okay, well, I appreciate your guys' time, and I appreciate you participating, and I believe this will be available elsewhere.
Yeah, for sure. And thank you, Alan, for taking the time out to produce or provide this information to our members. Feel free to check out our webinar page frequently as we produce more of these webinars in the future. So take care, and thanks for joining us.